You just received a letter of intent for $10 million. The ink is drying, and after years of building your business, your exit is finally sitting right there on the desk. Most founders treat that signature as the finish line, but the buyer treats it as the starting gun. That $10 million is a target range, not a guarantee. The exact same $10 million offer can leave you with $6.8 million under a stock sale, or just $5.3 million under an asset sale. That drop comes directly from how taxes, fees, and allocations are structured in the fine print. If you wait to model those mechanics until after you sign, you surrender your leverage. You end up draining your own retirement to pay for the buyer's tax benefits. This gap surfaces in the oldest standoff in the M&A deal room, the asset sale versus the stock sale. It is a mathematical tug-of-war. Every dollar the buyer gains in tax shields and liability protection usually comes directly out of your net proceeds. Give the buyer the exact structure they want, and the deal closes smoothly, while your final payout shrinks. Dig your heels in for your perfect structure, and you keep your margins, but you might force the buyer to walk away. Buyers usually push for an asset sale. In this structure, they aren't buying your corporate entity. They are cherry-picking the parts that make money, the equipment, the customer lists, and the intellectual property, and leaving the legal shell behind. They do this because it grants them a stepped-up basis. They record acquired assets at today's high purchase price rather than historical cost. That step-up lets the buyer depreciate and amortize that higher value year after year, creating predictable tax deductions after closing. The catch is that the IRS penalizes you for it. Portions of your proceeds get reclassified through depreciation recapture, forcing you to pay higher ordinary income taxes instead of favorable capital gains. Buyers also prefer asset sales because they establish a hard boundary against your company's past. If an employee files a wage and hour claim next year, or environmental surprises surface from decades of industrial work, the buyer wants no part of it. They leave those historical liabilities trapped in your old entity. And if you operate a legacy C corporation, the pain doubles. The corporation pays taxes on the asset sale, and then you pay personal taxes again when you distribute the remaining cash to yourself. It is a brilliant structure for the buyer. It insulates them from risk and maximizes their cash flow, entirely at the expense of your exit capital. Sellers, on the other hand, want a stock sale. Here, the buyer purchases the shares or membership interests of your actual legal entity. This structure usually lets you treat the proceeds as long-term capital gains, keeping your federal tax rate low and avoiding the double tax trap for C Corps entirely. It also delivers a truly clean break. The buyer assumes ownership of the entire legal history of the company, while you exit the business with your liabilities significantly reduced. Buyers resist this because they inherit the entity intact, the good, the bad, and the buried. If a lawsuit drops 3 years from now based on a contract you signed 5 years ago, the buyer can't point the finger at you. They own the shell, so they own the problem. A stock sale protects your final net number, but it demands the buyer absorb an unquantifiable amount of historical risk. California acts as a unique pressure cooker for M&A exits. The state layers massive tax burdens onto already complex deal structures. The state franchise tax board does not recognize a lower rate for capital gains. Every dollar of gain is taxed as ordinary income. That high baseline tax floor strips away the federal padding most founders assume they have. You start the negotiation already at a deficit. Add to that the aggressive regulatory environment. Buyers are hyper-aware of California's wage and hour laws, of PAGA claims, and strict environmental codes, making them fight even harder for the safety of an asset deal. You cannot rely on favorable tax rates to save your margins here. Negotiating the deal structure itself is the single most effective lever you have left. So what happens when a buyer looks at your history and refuses a stock sale because they're terrified of the liability? You introduce a structural bridge. The first is reps and warranties insurance, or RWI. Instead of forcing the buyer to trust you, RWI transfers the risk of historical breaches away from the two of you and onto a third-party insurance company. You pay an upfront premium for the policy, but in exchange, you eliminate the need to lock millions of your dollars in a massive escrow holdback to soothe the buyer's nerves. By neutralizing their operational fear, RWI gives you the leverage to keep a highly profitable stock sale on the table. But sometimes liability simply is not the issue. Sometimes the buyer outright demands an asset sale purely because they want the depreciation tax shield. When that happens, you deploy a gross-up. You sit down with your CPA, calculate the exact dollar difference in your net proceeds between the two structures, and demand a higher top-line purchase price to cover the gap. If they want the long-term benefit, this forces them to finance their own tax shield with a premium valuation, rather than quietly siphoning it from your retirement. Clean service businesses should aggressively push for stock sales from day one. If you run a legacy C Corp or an industrial business, model your net proceeds immediately and prepare to deploy RWI or gross-ups to defend your payout. That $10 million letter of intent is just an opening move. Mastering these structural mechanics is how you ensure the headline number you sign for becomes the actual wealth you walk away with.